Y para hacer esa entrevista tengo aquí con nosotros a nuestra compañera Valeria Gómez. Muy buenas tardes.
Buenas tardes, Salma. Pues sí, contamos con la presencia de Teresa Keane, Product Director at Alliance Bernstein. Good afternoon, Teresa.
Good afternoon.
Good afternoon. So nice to have you today at Negocios Televisión. It's been a turbulent and uncertain year so far. Now that we are in the final stretch of the year, 2025, has been marked absolutely by volatility and uncertainty. As we enter the final stretch of the year, we take a closer look at how equity markets are performing. And my question for you, Teresa, is how are equity markets performing yet today?
Well, you're absolutely right. It has certainly been a very uncertain year for the financial markets and the economy as a whole. We saw two significant sell-offs, of course, at the beginning of the year. But markets actually have bounced back, and they've been willing to take a positive view. And what we're seeing so far, and certainly in August, markets were again positive on expectations of a rate cut, clearly to come in September. But also what we saw healthcare coming back. It was one of the strongest performers, followed by materials. We saw some weakness in utilities and industrials. But what we're seeing year to date is some positive equity performance. US equities, for example, are up 11%, global 14%, but non-US equities in particular are performing very strongly, up around 22%. So all in all, a positive environment. But of course, the uncertainty that we have experienced and continue to experience has raised some significant questions. There's no doubt about that. There's some questions with regards to the role of the US in the global economy. There's also some questions with regards to the US dollar and whether that should remain the reserve currency or will do going forward. And of course, treasuries, the risk-free asset given the policy-induced disruption. And you can see that the VIX levels have come down to quite low, as well as the uncertainty index. But we as active managers really do see that that uncertainty is likely to continue. And while markets have been positive with regards to the trade deals, at the same time, the increase in tariffs is significant and likely to impact going forward, as we have seen continued price increases as well as an impact on growth. So all in all, although the VIX is low across all of the asset classes, a significantly choppy environment perhaps for the rest of the year.
And Teresa, as you said, markets are constantly evolving as well. What has shifted recently, and how are you positioning in this response?
Well, what we've seen is, you're absolutely right, markets are continually evolving. We saw quality performing strongly earlier in the year, but then coming into the second half, or the first half, should I say, we saw underperformance from quality, stability and price. And what we're seeing more recently is strong performance coming out of speculative tech and also strong performance with regards to crypto-related securities. What hasn't changed, of course, is the concentration in the market, so that's still continuing, although we are still seeing a divergence of performance within that cohort, which is a good thing. In terms of our overall positioning, we have been underweight the US for quite some time, actually, mainly because of valuation, and we're overweight non-US. I should add, though, in terms of revenue with regards to the US, although we are underweight, we're still able to find these quality companies. And in terms of revenue, we're neutral to the benchmark. So in a way, offsetting that underweight. As a portfolio and as a strategy, we're actually overweight services and underweight goods, which actually is a good thing in this type of environment. So within the likes of consumer discretionary, we like names like Compass and Booking.com. Within industrials, we like the professional service companies like Relx and Wolters Kluwer. And again, within technology, we continue to be underweight semis and overweight software. As active managers, we believe it's really important to identify these quality, resilient and durable business that's able to withstand that uncertainty in these environments. And we are seeing quality, we are seeing healthy growth coming out of the non-US region at this particular time, I have to say. And what we're seeing is industries also working together. So, for example, we're seeing the convergence of power and technology really driving demand growth across multiple industries. Our research is suggesting EPS growth, for example, across electrical equipment, aiding that electrification to be in the region of around 22%. Additionally, aerospace and defence is also showing EPS growth in terms of around, again, 23%. So as active managers, we really believe it's important to be able to identify, using our fundamental and quant research, these names that are high quality, stable, but also attractively valued. Valuation and price is always going to be a bit important. We want to avoid that crowded trade. That crowded trade ends up being vulnerable and disappointing over the long run. And that is something we want to avoid.
And Teresa, in such a complex environment that we are right now, investors often ask whether equities still matter. Here's why they remain essential. Why do we need these equities in this type of environment right now?
Absolutely. We certainly do need equities that are important. We need our capital to grow the distance. We need that long-term growth. We're all living longer. But ultimately, we also need, and more importantly, we need to be able to beat inflation over the long run. This year, though, has been about really staying in the market throughout that uncertainty. So how can we give investors that confidence to stay in the market? And in fact, we did some research with regards to how US equities have performed throughout the various decades. And you can see here, if we take the last set of bars, for example, the S&P cumulative returns, staying in the market over that decade or over the current decade delivers approximately 72% cumulative return. And if an investor came out of the market and just missed the 10 best days during this current decade, that return moves to -4%. That's a significant price to pay for trying to time the market. We really don't believe that you can get in and get out of the market during these various periods. And of course, the longer the investment horizon, the more possibility of reaching your investment goal with less risk, taking that active approach.
And according to all this active management, we see that it's back into the focus. Can it really help to mitigate these risks in today's markets, or can an active approach reduce this risk?
Well, that's a great question. And quite frankly, that's a question that we set out to answer back 10 years ago and over a decade ago when we launched our strategy and our approach. We wanted to deliver, quite frankly, an uncorrelated pattern of return, both to passive but also to other higher beta and should we say growth or value strategies. We want to deliver that uncorrelated pattern of return so that ultimately what we do is reduce that risk over the long run within the equity bucket, and also improve that Sharpe ratio. So when you think about our strategy, we think about diversification, diversifying that equity bucket, pairing it with either a higher beta strategy or even with passive, and then of course, ultimately that improves the Sharpe ratio and reduces risk. Now, if you're complementing this with fixed income, clearly there is an increase in risk because it is equities. After all, the beta of this product is 0.8 to 0.85, but there will ultimately be an increase in return. So all in all, what we're seeking to offer to our clients is consistency. Consistency in terms of mitigating that risk, but also participating on the upside when the market is rising, so that in markets like this, investors stay confident and just stay in the market in order to reach their overall end goal and financial gains.
Thank you so much, Teresa, for being with us today at Negocios Televisión. We say bye to you, but we will see you soon, I hope so. Teresa, Product Director at Alliance Bernstein, thank you so much.
Thank you very much. Bye-bye.